Matthew, how are you, man?
Doing well, guys. Happy summer. Glad to be back joining you here for, I guess, I don't know, we call them these quarterly updates now. I've been doing these with Marty for a while, and always happy to share the base money love with other outlets as well.
We appreciate it,
been on a little while.
Yeah. It has been a while, but always glad to be on.
Nearly a year.
How you doing, Danny?
I'm good. I'm all beat up though.
So what happened to your face?
Try and hide it. I was just boxing today.
Listen,
this is my first ever boxing injury. I'm very proud of it. No, I just got caught.
Did you get knocked down?
No, I'm a tough guy.
Did you not see me boxing in Ghana?
You boxed in Ghana?
Dude, I bullied Danny to box in Ghana. So we were out there making this film, and we went to this district. What was that area called? Jamestown, yeah.
Jamestown.
It's where all the boxers are, right? And they're proper hard. They like sleep in the gym on a hard floor, and then they run all day and then fight. And so I bullied Danny to get in the ring and fight this guy. But in fairness, Danny did all right.
Love it, man.
All right, Matt. So we're going to be talking about debt, the endless ability to create endless debt.
Yeah.
Little consequence.
Yeah, so I got a nice little series on my YouTube channel right now on the national debt. You can check that out, and we can go over some of it today. But it's a perennial topic, right? And I like to put things in, I think, simplified terms and let you understand it. Maybe be able to ask some questions on that. So yeah.
All right, just make sure we explain to the people listening and not on YouTube.
Yep, absolutely. Since we're doing debt here, we got the whole history of the United States debt. And obviously this is linear scale. So you can't see anything before like the year 1975.
But we started at 1789.
We do, right after independence from you guys. And I got this on log scale right now, just to show that you don't actually need a central bank to have debt. We had two central banks at the beginning. Andrew Jackson famously took, paid back the debt and ended the charter of the Second Bank of the United States in 1836. But point is, even after Civil War, we raised some more debt here. We're talking, a couple $1 billion.
Is it just private debt?
No, this is government debt. This is federal government debt. Always, rises after wars, recession, so on and so forth. But this period right here. And for our listeners, this is basically a flat line on log scale. You're looking at after the Civil War, 2.6 billion in debt, all the way to World War I, 2.9 billion in debt. So it's basically flat, down at sometimes, up a little bit. This period right here was the greatest economic growth ever, really. Perhaps China could rival it in the last 10, 20 years, but it's debatable. So greatest economic growth in the history of the world, and the United States national debt was flat or even down at points. So it's an interesting thing to keep in mind.
Have you watched the Millet speech at the World Economic Forum?
I have, yeah. I've watched a couple of them, though, so you're going to have to remind me what the main point is, because it's...
He talks about the biggest period of growth, like the largest period of growth during the Industrial Revolution. I'm pretty sure he's covering the Industrial Revolution.
Yeah.
And, it was explained that it happened under the freest times, when people are the freest. And now we're kind of restricting people. We're reducing freedoms, increasing debt, and destroying productivity.
100%.
But I'm pretty sure he picked out the same region as you, that same kind of period.
Yep. That's the second half of the 19th century for the United States. Basically no debt or flat debt, and just wonderful economic growth. So it definitely pokes holes in the theory that you need debt to have growth and so on and so forth. But I go into this more in depth in the channel. But what I just wanted to show you is, once we have World War I in the United States, literally the start of World War I, the Federal Reserve opened its doors in 1914. U.S. wasn't in the war yet, but Fed founded in 1913, opened their doors in 1914. And so you can start, the best way to measure, understand how much the debt is being bought by the public versus the central bank, is just compare it. It's not something that's done often. And so let's zoom in here the last 100 years. Still, you can't really see it on linear scale, but I'll explain here for the listeners. Basically, I'm going to put on the screen on the right-hand axis a percentage, and that's how much the government owns, how much the central bank owns of the United States national debt. All right, so it's a black line here. The highest is 30%, and that happened during COVID. But if you look at the Roaring 20s, even the Great Depression, the amount of money that was actually printed by the central bank, and once they do what they do when they print the money, they have to buy something with the money. They don't have to buy debt. This is another misconception. They could buy, like the Swiss bank has bought Facebook stock, Apple stock. Bank of Japan has done that as well. They could buy real estate. They could do anything they want with printed money. This, again, if you just state this, obviously, it shows why we're interested in Bitcoin. But what they typically do, and what the Bank of England actually started a few hundred years ago, is they buy the sovereign's debt. They buy the government bonds. But it's interesting. It took a while, the United States, to really get into it. If you look here during the Roaring 20s, 1%, 2%, 3% of the entire government debt, I'll zoom in, is purchased by the Federal Reserve. Okay, so where the federal government had, say, 30 billion here at the end of World War I, because you print money during wars, the Federal Reserve only owned, that means they only printed 1% of that. So it's kind of again, just to show what the common narrative is how we always need to print money to move forward, and we need to have debt to move forward, this and that. It wasn't even happening, during World War I.
So the rest of the debt is what?
Yes. So the rest of that percentage, in this case, 99% in the Roaring 20s, is owned by regular creditors like you and me. We had savings bonds, war bonds. The public bought it. It's true that other central banks could buy it as well. I'm not factoring in that. That is a bigger portion today than it was even during this time. But it's just other people in the market buying it. So the interesting thing, again, as it relates to Bitcoin, is this black line is basically, it's another way of looking at the monetary base, which I always talk about, the base money. It's a exogenous factor coming into the system. It doesn't need to be there. As we just talked about during the 19th century, it wasn't there, right? Doesn't need to be there to grow your economy. You can shrink the debt and still grow the economy here, as you see in the 19th century. But what the money print is it's literally, there's an economic term for it. It's called outside money. So all this black line, what it represents, and in the nominal terms, you can see it's the green shaded area, the dark green shaded area on this chart. It's the actual monopolistic outside money that comes into the system. And just another point on that, if we look at post-World War II, when we're on a full dollar system, the Fed owned about 10% of the debt. Okay? They pumped the debt a lot after World War II. You see we're at like 50 billion, went up to 250 billion, standard stuff. But still, the Fed only owned 8, 9, 10%. And then as the Vietnam War continued, what happened? We see a climb. So from 10% all the way to when the Vietnam War ended in 1975, it was 18% of the federal government. And this is the reason that the French, in particular, like Charles de Gaulle, they started to call their gold back. They actually did it. He did it at the end of the 60s. But just so people know, at the end of the 60s, the Federal Reserve only owned 16% of the government debt. And that was too much for the French. So these are interesting historical parallels when we look to today. It took only about 15, 16% of the debt being monetized, being printed, outside exogenous money coming into the system and buying government debt. And then, of course, down the line, that devalues the dollar. It took about 16% of the Fed owning the United States government debt before Charles de Gaulle pulled the plug on it. And then, of course, Nixon ended it. And then if we back that out, of course.
Well, just a second. So is the government owning the debt, is that a measure of how much they're living outside of their means.
If I say government, let me be clear, of the central bank owning the government debt. The central bank owning the government debt. And it's one measure. Yeah.
So this is the Fed printing money to buy their own bonds.
Correct.
It's a measure of how much they're living beyond what they can afford.
It's a floor in the market that nobody knows where the floor is. Okay, it's a moving thing. That's why it's good to look at these long-term charts, in my opinion. But what they do is they put a floor on the value of government bonds. And if they were not there, for example, if this 15% wasn't there and 100% of the debt had to be bought by the public, then presumably the price of the bonds would be lower or the interest rates would be even higher. And that would be a hard thing on the public. And that would be difficult for the government. So I'm answering your question, but in the way that the financial markets kind of interpret this is when the government steps in and buys the debt, they create a floor on the price. And what that does when you increase the price of the bonds in debt, it's an inverse relationship. You've probably heard it. So the price of the bonds rises, the yield falls, and it's easier on everybody because interest rates fall everywhere in the market because of that. Does that make sense?
So they're doing it to stimulate growth.
They're doing it to make it easier on themselves because they can.
But on themselves or the public or both?
Both. Because themselves, and I'll show this in a second, themselves because the government, who they're, it's just Peter robbing to pay Paul, this type of thing. The government is obviously related to the Federal Reserve, no matter if you want to say the Federal Reserve is a private company, that doesn't matter. It's a monopolistic entity. The Federal Reserve is helping the government. They buy bonds. And while they're buying those bonds, the interest rates will be lower, so the federal government has less of an interest burden. However, if they do that, there comes to a point where the public or other holders of that debt might get suspicious, as I'm showing you here, which is the first time in history, the United States history in the 60s, where the Fed went from owning 10% of the debt to owning only 16%. And no one knows, this is, again, it's kind of Wittgenstein's ruler. No one knows where the true North Star lies. You can look at what's happening in the gold markets. You can look at what's happening in the property markets. But it took only 16% of the Federal Reserve buying 16% of the United States government bonds for the French to say it's enough. Give us our gold back. And that ended the gold standard. So the point of saying this is if in the 60s we went up to 16%, what happened? It actually, by the end of the Vietnam War, it got to, which was in 1975, it got to 18%. And then the Fed decided to cool off a little bit. But really, when I say cool off, they were just kind of, if you look at you see this whale down here, they had 88 billion in bonds. They still kind of bought more. But what is actually happening was the government was even issuing more debt. during the mid 70s. You can see how the debt it increases a faster pace than the Federal Reserve holdings. And if we pull that all out, this is another interesting point, is basically this period. Now I'm showing for the listener here, 70s, the 80s. You see the debt increase at a pretty moderate clip, but if you just look at the lines, it's increasing faster and faster as you go into the 70s and the 80s. This is the exact same time that all of the talking head economists, the silver grays, the people that say that they know how the economy works and debt is fine and deficits are fine, and the teachers of the MMT people as well, the Keynesians, this is the time that they were cutting their teeth, is when the United States could even issue more debt than the Federal Reserve was buying. Therefore, the percentage falls. So the Fed now by 1991 only owns 7%. But the Federal Reserve is just kind of buying it at a standard clip, U.S. bonds. They're not buying too much, not buying too little. But the United States government is issuing more and more debt. And it's fine. The Soviet Union collapses. Liberalism wins. It's called the Great Moderation in economics, this period of the 80s and the 90s. Is this also this term deficits without tears? Deficit is just a 1-year snapshot of the debt. The debt is the entire accumulation of deficits. This is why they don't think it's a problem, is because in the 70s and the 80s, the Vietnam War ended. We thought it was too much debt, but no, actually, let's just keep printing more and more. Not printing more. They're also printing, but let's keep issuing more and more. Foreign creditors will buy our bonds. This sort of deficits without tears idea, and they do. So that's something to keep in mind, is that exactly during this period is when all the talking heads, the blowhards that you'll see on TV talking about how deficits don't matter. This is when they were learning about economics.
And they thought they had it figured out.
Yeah, precisely. Until this time came. Global financial crisis. And then just, to finish this chart off, obviously you just have insane things here.
On the global financial crisis,
yeah,
there's a dip. Is that dip before the crisis? It's before the crisis hits, right?
It is.
Is that the collateralized debt obligations blowing up?
You're correct. But before they blow up, you'll even notice the U.S. Federal Reserve holds less of government bonds than they did. So it starts to dip in about November 2007. This is a year before. Remember, everything blew up in November 2008. So a year before. So it's interesting what's happening here. What they're doing is they're actually saying, okay, we don't want to shake the market. They knew that things were wrong, but they said, we don't want to shake the markets a little bit. Let's shed some of our government debt on our balance sheet, which means let's actually let the market take it back. They're actually destroying money a little bit during this time. But what they're also doing is they're buying corporate bonds. A lot of the creditors of Bear Stearns, that's the big one that happened. They're doing some little mini Wall Street bailouts during this period, and they thought they could get away with it, but they didn't.
Would them selling down their bonds not exacerbate the situation, though?
It does, because you're also a good point. Once they sell the bonds back into the market, that floor is removed. Remember, we just talked about that floor that they put. When they remove the floor, interest rates rise, and interest rates were rising all this period. And then no one knows the peak, right? No one knows when and there's another good point is like, if you take off this percentage line, if you just looked at the debt itself, it was rising, let's say it was 5 trillion, 6 trillion, imagine that number, 6 trillion in 2002, just post 911.com. It got to 9 trillion in August 2008. There was nothing on this chart in particular that looks any different. But so that's another point about debt is you gotta look at other things in the economy. It's not a predictor. But it is true that if you look at the Federal Reserve's portion of the debt, it shrinks because they're buying other things. They're buying corporate debt at this moment, corporate paper. They're bailing out Wall Street, even in 2007. And because they sold their U.S. government bonds, exactly like you said, Danny, the interest rates rise, and that makes it harder on everybody else. So they thought they could do this little switcheroo, try to bail out Wall Street a little bit in a soft way. It didn't work. Global financial crisis happened. Then they realized, all right, now we got even more bad debt on everybody's books. They have this, as you mentioned, Peter, the CDOs, collateralized debt obligations, all that stuff that came here.
So they knew what was coming.
They did. I have another chart that can show you that, but they definitely knew that it was coming. Also, another thing, they stopped publishing data in 2006. The money supply data, all this stuff, they stopped publishing in 2006, right before the crisis. And you look back and you can see why they probably stopped publishing this, because they lost control of what was happening. And then Ben Bernanke, a student of the Great Depression, says, let's look back at the Great Depression. If we look at the Great Depression here, it happened in October of 1929. Okay, that's what you see that on the chart. The U.S. Federal Reserve only owned 0.9% of the debt at the time, and they did still buy bonds during the Great Depression. They did print more money to buy bonds and bail out the government, but they didn't really get started until Roosevelt came in, and this is Roosevelt's New Deal. Actually, you can even see it. All right, so they're monetizing the New Deal. The percentage jumps from 0.9% before the Great Depression, in the early 30s, 3%, and then it jumps up to 10% already by 1932 and 33 when they confiscate the gold. But Ben Bernanke said that this was not enough. They should have done more. You could see they're trying to tell you that you just need to do a little bit more. History is telling us we just need to do more and more and more. And he was true to his word, because this is Ben Bernanke coming in and realizing, all right, I'm not going to let the economy crater. I'm going to bail out everybody. And you can see it. QE 1, 2, and 3. 3 big humps here of when the Federal Reserve took way more debt as a proportion than they'd ever have. And this is now a record. So remember, in the Vietnam War, we were only at 18%. Now by July 2014, the United States Federal Reserve, the money printer, owns 23% of the debt.
And how do they tend to unload their debt? What's the mechanism?
Slowly. They broadcast it. Another point, by the way. So what you're looking at, the green shaded area here, it's $4 trillion now the Federal Reserve owns in debt. The debt itself is $17 trillion. Federal Reserve owes $4 trillion. Notice, tell me what you guys see here between 2014 and say 2018. What is the whale look like?
Federal debt is flatlining.
The federal debt is the light shaded green area. That's going up still. But what is the whale?
The federal debt holding of the central bank is flatlining.
Correct. It's flatlining. And it's an important distinction here is because this is the money print. And from 2014 to 2018, they didn't do anything. They actually let the old bonds roll off. The government itself issued more debt. You see the debt is increasing, and that's how they say they're going to try to normalize. But it's also important because remember these days from Bitcoin world, I've said this again and again. I mean, when I say these things, I'm not defending the system, but just you have to look at this stuff to understand what they're actually doing at certain times. And from 2014 to 2018, just imagine how many times you read on Twitter or anywhere in Bitcoin land, people saying they just print money all the time, print. This is the printing press right here, the whale, the dark green area. They weren't printing. They were trying to normalize. This is a word. They were using normalize the balance sheet. It just meant they were not buying as much bonds as they were before the crisis. Again, I'm not saying it's a good thing. I'm not saying they know what they're doing. I'm definitely agree with Bitcoiners and the standard tropes of our industry that the only thing they know how to do is print. But you also have to pay attention when they're not printing, and they were not printing during this period. Small point.
So who was taking on this debt then?
Other creditors. People were still buying it.
So they were buying. So they were just issuing a shit ton of bonds, and people were buying them.
The United States government continued to issue bonds, and foreign creditors bought them. The Chinese still bought them. The Europeans still bought them, and regular pension funds, investors still bought them.
And people are still happy to buy them, even though this is. It's a bit like if I go to the bank, right? If I want to get a mortgage, they want to know my other debts. They want to know what credit cards I've got, what loans I've got, because they want to know how creditworthy I am. Yeah, if the US government's up to like 20 trillion of debt, why are people still happy to buy their debt?
That's a good question. It's a relative thing, and the point of me showing you these long-term charts is I don't know the limit. I don't know the point where this thing breaks again. What I actually would say is I'd caution people to look at it the other way, to look at they can kick the can down the road a lot longer than you believe. That's my answer to the question. That's the way that I would look at it.
But is it because even with the massive US debt pile, it's still
the best looking horse, horse in the glue factory? Yes.
Yeah.
Yeah. So that's an interesting thing, and I think you can analyze it 6 ways to Sunday. I do that. If you want more details, on my channel, please check it out. But I think it's an interesting exercise just to say, like, look, what have they done in the past? How much have they owned in the past? They've gotten up to 17% when the gold standard ended. That caused the French to withdraw their gold. Now, during COVID, let's jump out to the next. People said COVID wasn't money printing. It was actually absolutely money printing. When this green area goes up, it's the Federal Reserve printing money to buy bonds. That's what they did during COVID. And it hit a record here in COVID, November 2021, thereabouts. I think it's the top, 28.3%. So at this point, November 2021, the Federal Reserve had owned more United States government debt as a percentage than they've ever owned. And as a gross figure, $8.2 trillion out of basically $29 trillion. That's what they owned. And it was bad. We had all this inflation scare. We had, prices rose here in Eastern Europe like 20% year on year, even more in some places, right? That this is real inflation comes in the economy. And now they're trying to correct it. And if we look to today, again, be careful. I caution people if you think that all they know how to do is print, that's one thing. But if you say all that they do in reality is print, that's another. They have not been printing since this point. So they've been keeping the if you look at the green shaded area, the whale on this chart, it was $8.2 trillion of money print, November 2021. Now it's $6.8 trillion. And as a percentage of the debt, of course, the debt keeps growing. It's even lower, 19.5%.
So is that cumulative or is that month by month what they're printing?
Cumulative. This is a cumulative figure.
Right. So when the money print goes down, where's that money going?
The Federal Reserve destroys it. They actually, this is mechanics of money printing. What they're doing is they're selling the asset back into the market. So the asset here, the green shaded area, is the government bonds that the Federal Reserve holds.
Yep.
What they do is they say, banks, we're going to debit your reserves now and credit you bonds. So basically, they flip the switch. So now the banks in the banking system, they have less reserves than they had before. The reserves are the money, and that's destroyed. That's gone. And they have more treasury bonds, United States Treasury notes, bills, and bonds. And that's how money printing works.
Do you consider the BTFP program to be money printing, or is that not in this chart?
It's not in this chart. It's there are a lot of softer guarantees, and that's one of them. That's one of them. There's a lot of guarantees here.
Okay.
And that happened after the Silicon Valley thing as well. Notice what happened a year ago, the Silicon Valley. You can't catch it on this monthly chart. There was a blip up. If you looked at the weekly Fed balance sheet here in March 2023, there was a blip up. It doesn't even catch it on the monthly. But a lot of these programs are implicit guarantees, and this is brass tacks. What you see on this chart is the actual. This is the money print. So I think it's interesting. The point is, again, I'm not defending these people. I'm not saying they know what they're doing. It's math. It's compound interest. It's a problem. The Federal Reserve started in the 1920s at 1%. Now we're at, we're coming down from 28%, but we're still at 20%, 19.5% of the government debt is printed. But this is what people got to judge. And, this is what,
but
by the way.
That's on the short term. That's like, it's coming down on the short term, but on the long term, it's still trending up.
Of course. Let's look at the trend line. Here's the it has gotten very volatile. This is the same chart. I'm showing you now cents on the dollar. Okay, same exact chart, but for every dollar it's the same percentages, right? You had 17%, 18% in the 70s. You got up to 28 cents on the dollar in was it November 2021? And we can do, as I like to do, the trend lines, right? So other than Bitcoin, we'll talk about Bitcoin in a second. Bitcoin's a power law. Most of finance, most of markets, they're exponential growth. It's compound interest. It's just what it is. So if you put it on log scale, it becomes a straight line. So everything here you can see is a straight line. That's the trend. And like you said, Danny, it just looks odd here since the global financial crisis. Obviously, it dips because they tried to bail out Wall Street in a big way. It didn't work. They still bailed them out here after. But you can go decades being above or below this trend line. That's a whole other topic. But like you said, Peter, over the long term, the trend line itself, which is not a great R squared, but 54%, still not bad. 24 cents on the dollar. That's the trend line. So we're actually below trend at that 20 cents, 19.5 cents on the dollar. But, that's way higher than it was ever before, except for maybe this period when the Bretton Woods system collapsed. But
is the trend line like the manageable amount?
I don't think so. That's why I'm happy that we have Bitcoin.
Oh.
That's right. I'm happy we have Bitcoin. But look, this is, we could go deep on this and look more. Let me show you one more on the debt, and then we'll get to Bitcoin. It's more fun.
Okay.
Here we got the United States debt. Now, these are flows. What I showed you before were full stocks, balances, right? Like pick a time, 20 trillion, 30 trillion. What's the amount? Now I'm going to show you how this works day by day, month by month, year by year. I'm only looking at the past 100 years. We got these big swings here. And what this is the deficit change every month. And it's a trailing 12-month figure. So this is a flow. So let's go back to what I said when people were learning economics in the 70s and the 80s, thinking that deficits were okay. This is everything here is on $1 of tax. All right, trying to make this very simple. It's on $1 of tax. So what you see here in, for example, June 1983, the deficit is 28 cents. That means that they took in $1, spent $1, and spent 28 cents. Excuse me, 40 cents more. The deficit is 40 cents. The average is 28. Let me take the average off. Just make it simpler. They took in $1, spent $1, and they spent 40 cents more. That's what you see in this chart. Okay. So the more that you see this red shaded area be positive, be above zero, in this chart, negative is actually a good thing, but you'll see why in a second. The worse it is. So you can see here, we had huge deficits during the Great Depression, during World War II, also during World War I, massive deficits, some surpluses here in the roaring 20s. But generally, this goes back to our MMT people, our Keynesian people. Look at this period when we went off the gold standard. People still bought U.S. government bonds. We were running deficits of 40 cents, 30 cents, 25 cents on every dollar. That means you take in $1 in taxes, spend $1 in all the other government services. You still need to spend 41 more cents. That's what you see here.
We had one small deficit in 2001?
Surplus, correct. Yeah, this is Bill Clinton at the end of his term, finally balancing the budget, which shows you how insane it really all is. Like, this was such a big deal. Bill Clinton, talks about this like it's God's gift to humanity. It's far from the norm. It's great that they did it. It was a divided Congress, Newt Gingrich, all the rest. But this is what economists learn in school. They learn that deficit spending is fine, even printing some is fine. But so as you can see, for our listeners, again, post 9/11, post.com, certainly post GFC, you have just a lot of red splashed on this chart, a lot of deficit spending.
But it looks like wartime spending.
And this is what they try to tell us is normal. If you take the average, by the way, just a simple average, it's 28 cents. That's what I mentioned earlier, 28 cents. So we're above the average. Right now, at this moment, we're deficit spending 53 cents. It means we take in $1, spend $1, and we spend in 53 cents more for every dollar of taxes.
Of that 53 cents, do we know how much of that is them spending on servicing their own debt?
Yes, it's right here. Interest coming up. All right.
There you go.
So here's interest. Now, interest is actually not, it's a big number, but it's not, as you can see, let's just take this average off. As you can see, for those that are watching, for those that are listening, there's no major spikes. There was a big spike here in the Great Depression, but generally, this is not as a percent of the debt. This is as how much on the dollar. Interest can be something like 10 cents on the dollar they spend. It can be 30 cents on the dollar they spend. At this very moment, it's 21 cents on the dollar. And let me give you the average. It's 20 cents. So that's another way to look at it and see where we are. But the interest is actually not a crazy thing. But of course, I'm not defending them. I'm not saying it's not going to be crazy in the future. When you start to look at it in nominal terms, it seems more scary. The United States government spends about $1 trillion in real nominal dollars on the military, and it's going to be about $1 trillion in interest over the next year. So it's, as a cents on the dollar, it looks historically somewhat normal, but when you start talking about the real figures, it's crazy.
And this is where we get kind of Ponzi-like, because if they cannot service their debt, they will have to print to service it.
Yeah.
And then everything blows up.
But here's the one thing I wanted to show you is this. It's surprising. Remember, we talked about the balance. I have the balance here as well, just to show you. This is the same chart. So it's the balance. But let's not look at the balance. Let's take off the interest. Take off the interest. We just have the deficit again, this red shaded area. How many cents they spend above and beyond $1.
Mm-hmm.
Let's look at the print now. And based on everything I've shown you, you probably think that this green thing is going to be splashed all over the red and very a lot of printing. But what I think you might be surprised at is if I put it on, it is crazy at times, but it's pretty mild at other times. So remember when I showed you that balance rising? I just put the balance on here. It's rising slowly in the 70s. Now I'm taking it off. This is just trailing 12 months. How much of the deficit is printed every 12 months? It's only a couple cents, typically. Again, where all of our economists learned things in the 70s and the 80s, they didn't have to print much money, and people would still fund the deficit. They would borrow. Is the average
8%?
The average of the print is only 4 cents.
4 cents.
But it can have wild swings. It had wild swings in the Great Depression, World War II, and then, of course, QE 1, 2, 3, COVID. But theoretically, they're on the positive side here. They are, as I said, they're destroying cash. Right now, for every dollar in taxes, they're removing 20 cents of money print to the whole system. It's actually a good thing what they're doing right now. They know that they've printed too much during COVID. Again, I'm not defending them. Don't need to say I'm defending them, but they're trying to pull it back. But of course, the inevitable conclusion of all this is that, in my opinion, they're going to do more. We know that when there's a crisis, when there's a recession, they'll print. That's the key. We see that they've done that in the past in a big way since the GFC, but even in World War II, Great Depression, whatever. What they would like to do is just have this sort of low grade print, a couple cents on every dollar of taxes. Very, very, that's what they would love. They're out, that train has left the station. So the question is,
why?
Just look at the last 20 years.
But why is it unrealistic that they can actually get back to it?
Let's put the print ballots on.
Is it because they can't really pay? There's too much debt now to pay down.
I can't give you a definitive answer on that question. It's a good question, actually. Just bluntly, straight up ask it. But these levels, during the Great Moderation, 1980s, 1990s, they were at 8 cents. 8 cents on every dollar of taxes was printed. I just don't see them getting back to that. The balance. Remember, they're at 20 cents right now. The balance.
Every one of these charts from about 2008 onwards is getting super volatile. And the volatility is what tends to happen in every market hyperinflation, right?
Yeah. But here's the other thing. So the balance is the black line. Remember, we've showed that in the prior charts.
Yeah.
The balance of how much they actually net have printed, the brass tacks, that's 19 cents. So 19% of every dollar of United States government debt. To get to the hyperinflation, you need to be well above that 50%.
But the trajectory is that direction.
It is. If we go back here, I think I only had this going out to the end of the decade. I don't have it far enough, but at some point, it's going to get there. And then once you go, Zimbabwe and stuff, that's 100%. It's literally no one's going to buy Zimbabwe government bonds except the central bank. That's the characteristic trademark hyperinflation. The Federal Reserve has a while to get there.
Aren't we having signals though? But I'm pretty sure haven't the last two bond sales been pretty disastrous?
They have. All these things are not good. Look, I'm not defending them. What I'm just saying is, don't sweat the small stuff. Don't sweat the average bond sale, whatever. See where they are. They're actually, quote unquote, doing a good job right now. They're normalizing. They're removing money from the system. They're selling their bonds. They're letting the banks take the bonds, and they're destroying the reserves that they had from the banks. They're theoretically doing more conservative monetary policy at the moment. We all know that's going to end.
But what does that lead to? And why does that end? Because it leads to recession.
Exactly. Because when they do this stuff, interest rates rise. I don't have a chart of interest rates, but everybody knows that interest rates are going up right now. This is a graphical representation of the monetary policy of why interest rates rise. They're destroying money. When this thing goes negative, they're destroying the print. And that causes interest rates to rise. Interest rates rise. It's a lot of pain for people with debt. They have to lower the rates, print more money, and the cycle repeats. So that's kind of maybe another way to answer your question, Danny. I don't see it going back.
Yeah.
I don't see it going back to the Great Moderation.
This is everything Lynn Alden told us would come.
Yeah, she's great.
And I think it was Luke Woman said to us, the only way out of this would be to run a very short, very high inflation period, wipe out the debt.
Yeah. The question mark, it's pain. It's absolute pain. The question mark is if, foreign investors would still buy bonds after that point. Arguably they could if you run it long enough, and then you start to have high interest rates, and they're like, well, I'll do a government bond paying 10, 15%. That's exactly what happened in the 80s. After this kind of crazy period here of where the French left the gold standard and all the rest, and gold hit $850 an ounce, all the rest. So that would be just repeating that, doing the hard work, destroy more money, raise interest rates, and cut spending. The problem is, though, they're not on any path to cut spending, as we see. They're still spending 53 cents beyond every dollar they take in taxes. So, again, I told you the all-time average there is 28 cents, which still is not a great average to have. 28% of every dollar you take is a pure negative, adding to the debt.
See, it makes me think, like, right now, what I'm seeing in the UK economy, we have similar, just less extreme. We have an election coming up in, I think it's tomorrow.
Yeah.
Fuck, is it tomorrow?
It is coming up.
Yeah.
Shows how much I care about actually voting. But look, we're seeing kind of the same here. But the answer, I mean, Labour's answer is more taxation. I mean, that's not going to help boost our economy. And as they tax more, people are going to have less disposable income. Something I'm experiencing with every business I run. We're feeling the squeeze, and then they're just going to have to print more.
Precisely.
But there's neither of the major parties have come and said, do you know what we need to do? We need to cut our spending.
This is why I just say thank goodness for Bitcoin.
Yeah.
This is why, and again, my message, it's not to say that they know what they're doing. Obviously they don't. It gets worse and worse. But my point is, I think it could get worse and worse for a lot longer. I mean, see how much red is here. See how much green makes it up a lot more than it used to in the 70s and the 80s. But it's still going on. They're doing it. Once this money destruction phase, which we're in right now, goes positive, i.e., the interest rates crush everybody and they can't do it. What we just talked about, they gotta print more money. They gotta lower the interest rates, and it just repeats the cycle. So the only way you get out of that is probably what Luke mentioned. You got to cut the spending, you got to cut the debt, and you got to raise interest rates, and all of those things are painful. It's just all painful. But they can do it a lot longer, I believe, than we think.
What do you mean, like multi-decade or multi-year?
Well, it's been 15 years. It's been 15 years of the Ben Bernanke full-on print money to fix a debt cold system. Yeah. We've done that for 15 years.
But I feel like the only real pain has been, I know we had the global financial crisis, but that was like a sharp shock. And it was terrible for anyone who lost their jobs or their homes, but the recovery was pretty quick. I feel like this has been the most notable, painful period for people over the last 2 years, where people have witnessed and experienced real inflation. And it's across the board.
I actually think the global financial crisis was very painful for even a decade for many people. It just depends on who you ask. I mean, I think this period of a lot of money printing, there was a lot of inflation that they tried to not talk about. I think it was pretty painful, and it's obviously just as painful now. But again, they can kick that can down the road once they start to print again.
I know, it's weird. I know what happened during the global financial crisis. It just feels like maybe it's just because I have a podcast now and we see the data more, but something has felt different this last few years.
Let's see. I mean, I'm a what's Groman's forest for the trees, right? That's his tagline. I'm definitely that type of investor and person that likes looking at the economy. I wouldn't, it's great that we have Bitcoin. Obviously, you have been doing that. I've been doing that for years, telling people that this is how they can protect their family. I have a hard time seeing that this sort of monetary shock is right around the corner, mostly because I see them doing, at least right now, again, I'm not defending them, but at least right now they are trying to cut it back, and that's giving them some more breathing room. So again, maybe we're going in circles on the same topic, but I don't see it smooth like it was here when all the economists were cutting their teeth. I see it much more jaggedy. and that's just more volatile. It's just more pain.
How much of this do you think is a political problem versus an economics problem? In that politically, the decisions they should be making won't be popular, and will ultimately see them not win elections, so they end up making the wrong decisions to essentially maintain power.
Well, we see what's happening in the United States. I think that it's definitely a lot political. I think they're gonna be challenged to make the right decisions, like you said at the UK elections. Nobody's really talking about doing the hard things, but also another thing that probably confuses the issue. You know where I am in this part of the world. You know, we have a lot more wars. We have wars in Europe now, and that's going to very unfortunately, sort of make this whole picture even more opaque. People are talking about we need more spending on defense. And this is probably something that's you guys aren't thinking about as much in the UK or Australia even, but where I am, I mean, everybody, Finland, the Baltics, Poland, everybody is just massively increasing defense. And if you increase defense, when you really can't cut anywhere else, you're going to increase the deficit. So they're going to keep doing it, and they're going to do it in the name of something political, something quote unquote necessary. So again, all these things are hard problems, and you know they're part and parcel. What you see here is the marriage of monetary policy and fiscal policy. So it kind of, I would say, fiscal policy had a much more free ride here, at least in the United States, as we've been talking about in the 80s and 90s. Now, fiscal policy needs a lot more help from monetary policy. And, you know, you be the judge of, is it 50-50 or what? But they're not divorced. They're going to keep, there's no way that they can't increase deficit spending and do all the things that they say they need to do without printing again in the future. So that's my message.
Good for Bitcoin. Depressingly good for Bitcoin.
I would say that as well. I was never one of these doom and gloomers that hoped for a crisis or hoped that, the lower class gets stepped on more.
Eviscerated.
Exactly. When they go to the grocery store and all that. But this is why you have a podcast. I have a podcast, and we study this stuff. I mean, you got to find ways to protect yourself amongst this madness. Let's do gold really quick.
Yeah.
Here's an interesting one. So this is World Central Bank gold stock. It doesn't change much. People talk about central banks buying a ton of gold. They do, but the nadir, the low here, was about a little under 1 billion ounces of gold that central banks owned at the time of the GFC. Okay. And the last time, well, let me just say that it was about 1 billion ounces of gold. Now central banks own about 1.1 billion after 16 years after the GFC. Not a huge rate of increase. People talk about it all the time, whatever. So here's the BRICS as well. This is a big fear-mongering thing that Daddy Putin likes to say, that, the yuan, ruble, BRICS currency is going to be backed by gold and amazing. It is true that BRICS countries are buying more gold. Okay. They own, of the 1.16 billion ounces of world central bank gold, BRICS countries, that is Brazil, Russia, India, China, and South Africa, own 0.18 billion.
Have you got that as a percent?
180. Yes. Do it right here. It's something like, 15. It's 15%. Sorry, I didn't want to put that on there. It's 15%.
I want to see the BRICS percent.
Right. I actually only have world, but my point is,
no, you've got it there. I can see it. BRICS percent of world stock.
But it's world. This is central bank stock. The point is, I was actually, you took my thunder away, Peter. I was gonna show you how this isn't a big deal, because now I'm going to put on the entire. This is only gold that's in central banks. All right.
Okay.
Now I'm going to show you the entire stock of gold in the world that's ever been mined.
Huh.
All right. And for the listener, We were looking at 1.1 billion ounces, and the entire world gold stock that's ever been mined is 6.8 billion ounces of
Go
gold.
back to the global financial crisis, though.
Yeah, here.
Yeah, just on that line.
Yep.
Yeah, so it was what they owned about 1 billion ounces against 5.2, and now they got 1.1 against. Yeah, so the world gold stock's increasing at a faster rate than central banks' holdings.
Correct, and that's what I wanted to show here. So it is increasing. I'm not scoffing at it, but I hate. There's nothing more that I despise than a gold bug on Twitter, like saying how great it is that human rights abusing.
Peter Schiff.
Yeah, human rights abusing Russia and China is going to help this stack. I can't just despise that anymore. But so central bank percent of world gold is decreasing. All right, it's only 17% of the world gold stock, and the BRICS percentage of that is increasing, but it's only 3% of 17%, or in other words, as we just did a calculation, 15%.
Yeah, okay,
15% though. So it's something. They're trying, but this is an asset class that grows at 1.8% a year. Bitcoin now emits at a lower rate than that, right? It's sub 1.8% since the last halving, and you decide which is the best place to put your cash. And by the way, this 1.1 billion ounces of gold that central banks hold hasn't been that level since the 1960s. So it shows you again, it is shifting. They're buying more, but it's not the way that Peter Schiff portrays it.
Yeah.
All right. So that was gold. Now, Bitcoin. You remember this one? The old PowerLaw. Have you guys been seeing this on Twitter? The power trend line?
Yeah, we've been avoiding it, though, haven't we, Danny?
Yeah, I don't. Tell me what you think of it, Matthew, because I'm definitely not bought into this.
Yeah. Okay. So I just want to say, I think it's quite funny when you have different models. I know Saylor says all your models will be destroyed. That's great. I actually agree and believe with that could happen with this sort of hyper Bitcoinization scenario. What I like to use this as is simply a guide to see where we've been, where we could go. I think it's funny. I first tweeted about the PowerLaw in 2018, end of 2018. And you guys know I don't tweet so much, whatever. I just put out the stuff that I like. And then, our buddies over at the Stock to Flow Plan B Club start tweeting about this stuff or whatever, putting these models together of the Stock to Flow thing in 2019. And, we know where that's gone. So the point is,
hold on, it's back on track. Have you not seen the chart recently?
I have one question for the Stock to Flow camp, and that's just why would it work with Bitcoin, but it doesn't work for something like gold or silver?
I'm just telling you,
they'd have to.
Plan B's chart. We're back, baby.
Yeah, he's using a PowerLaw, as far as I understand it, to connect the dots there to line up the Stock to Flow. All the rest. There's basic trend lines. There's 4 basic trend lines. All right. There's linear. That's a straight line. There's exponential, which becomes a straight line on log scale. I showed you one. There's logarithmic, which is a bit of a sharp start, and then it's a little bit asymptotic. And there's power, which is more gradual asymptotic. So there's 4 basic trend lines in math and statistics. Bitcoin amazingly follows the PowerLaw. And I've been showing you since 2018. Here, let's do this one. Same thing. This is the PowerLaw trend line. We can talk about where it predicts. The thing that's different about when you graph stuff like this versus, say, using TradingView or whatever, is we can adjust it. It's not, you don't have to be married to it. Plan B's thing is based on this holier than gold and silver sort of stock to flow ratio of Bitcoin, which again, it doesn't work for gold and silver. But with Bitcoin, if the price moves up or a little bit down every day, you just feed that into the model and the model will adjust. So this is not technical analysis. This is just very basic. Find me a trend line. So look, this is the full pricing history since, I think it's from yesterday when I have the data. Yeah, July 2nd. Okay. Full pricing history of Bitcoin. I started at Bitcoin Pizza Day. If we only looked at what happened in 2010 and we drew a PowerLaw over it, how would it look? Would it look like this? You guys think? Would the line be sharper or would it be about the same? What do you think?
I think you've showed us this before.
I have.
So I think I know. So Pete, you go.
No, I don't want to go. Whenever I'm told to go, I always go wrong.
It's the same, isn't it?
Yeah.
Look, it's not. It's very fast. This is the 2010 front line. So
shows how much I remember.
But this is what I'm trying to tell you is
more data gets you more accurate though.
Exactly, but this is not what's happening in the stock to flow model. There's some religion going on there, but this is simple math. I'm using one input figure, not trying to adjust anything versus how the data actually looks. This is just using the actual data. And look, you can fall off of a trend line, no problem. This is a power trend line only using 2010's pricing data. And let's just take it out till today. What does the trend line say for today? $2.6 billion per Bitcoin. You're not reading that wrong. That
sounds better.
Yeah, that's the 2010 trend line. So we're off it. It's okay. It's okay to fall off trend lines. Not a big deal. We're off the 2010 trend line of Bitcoin. But here's the interesting thing.
Hold on. Did we even have proper price discovery in 2010?
Also a good question to ask. But look, this is why I asked you if it would be faster or slower. You see that it went very quick. This is a Slashdot article, by the way. Happened in July 2010. A lot of coders figured out price spiked like 10x. I'm rounding to zero, unfortunately, so you can't see it, but it went from like 10 cents, 1 cent to 0.1 cents to 1 cent, I think it was. In any event, you see that it's a lot of big jumps and really quick. And by 2011, we're already at $20, $30 for a day. So it's a huge trend line. If you draw a trend line over that, it's going to be very fast. But here's why Bitcoin is very interesting as it relates to this mathematical power regression, which is only one of 4 types of regressions. It's nothing fancy. I've been talking about this since 2018. Let's take off the 2010 trend line and let's put the 2016 trend line. Now, same question. Where do you think the 2016 trend line is?
Be below.
I'm going to say the same again, because I'm sure you showed us one that was the same.
It's the same. You're right, Danny. Danny's got it, Peter.
I just assumed you were tricking
Pay
us.
more attention for next one. So look, you can't even see it. I'll zoom in just a little bit. You can barely see it. Look at that. It's right on it. All right. So
isn't it just below?
The trend line. The trend line now is below, but the 2016 trend line is above. So point is, if you took all the data and you stopped at 2016, projected the trend line out, you get $77,000 Bitcoin. The all-time trend, which is all the data up until yesterday, 74,000 per Bitcoin.
It's going to be like this on every single one now, is it?
Yes.
Because we just didn't have proper price. We didn't have proper price discovery in 2010.
That's what I'm talking about. So now this is how you can understand that Bitcoin actually follows a power law. From 2016, I'm just going to put them all out here until like 2022 because I don't have. All right, so Let's even zoom in. Let's zoom in a little bit more. All right, I'm going to put in 2017, 2018, 2019, 2020, 2021, 2022, and then the all-time trend. So we're actually with the big, I guess you weren't talking about in
hold on, they're all slightly above.
Yeah.
So should we just be excluding the data from 2010 entirely?
We are. It's not on this.
Oh,
yeah.
Okay.
This is the 2010 data would take us way up there.
No.
It's gone.
No. What I'm saying is, is this data built over what period?
I see what you're saying. No, I think that you keep it because, I'm going back actually to the Genesis block. If there was even little pieces of data before, I would get it. But
what I think what I'm getting at is if you took out that first kind of 2 years, would essentially all those lines pretty much be dead on?
I don't know the exact answer to that because I haven't run it, but they would be perhaps closer than they are now.
Yeah.
Because
I just think 2010, there wasn't when did we get the first exchange?
2011, probably. Empty Gox was being traded over from.
Yeah, I just don't think we had proper price discovery. So fuck 2000.
To Carpellis. It was 2011 or 2010, maybe even end. But anyway, no, you're right. And as I'm taking this from some old sites here, New Liberty Standard, people were offering, people were talking about electricity spend for pricing on, buying on PayPal, all sorts of stuff. You are right in that if you look at all these lines, if you look at every line, it does include that crazy trend of 2010. It just comes down rapidly once you get the better data on. So you're right. But now look, the main point is it's clearly on a power regression, and every day now, and I'm just have my cursor on $60,000 Bitcoin, $61,000 Bitcoin as of July 3rd. So I did have today's on here. Yeah. $60,000.
So we're below where we should be.
We're below trend, but just barely. And all the other trends have been above it. Now, as well, this has not always been the case that we go down. Once we go back into a bull, which everybody knows that we will, that black line, the latest line, the all-time line, will pull back above. So this is why the model is just, it's not fixed to anything. It has nothing to do with stock to flow. It has to do with supply and demand, which is price. And, and that's how you map it out. And that's how you can tell that Bitcoin follows a power trend.
Can you zoom in for 2025? When's our bet with checkmate? Is it end of 2025, Danny?
Yeah, I think so.
Let me go back to now I'm putting the 2 percentiles up. Remember, this would be more interesting. This shows you the standard deviations, basically.
Show us into 2025.
Yeah, let me show you 2021 so you see it. We got over 1 standard deviation, but not to 2. We got to 2 on 2017. Back up a little bit more here. So what this says, just so you see, dear viewer and dear listener, basically, anytime you're outside of these blue bands, you're outside of a 1 sigma move, that means outside 2/3 of the time. Anytime you're outside of the red bands, you're outside a 2 sigma move, or 95% of the time. So we actually didn't hit that in 2021 at either top. We got out of 1 sigma, but not 2. And here, as we see, we're right on.
We know why.
We're right on. Yeah, we know why. We're right on trend. And let's go out to the year, right? We presume on the 4-year cycles, it's going to be end 2025.
So between 1 and 2, Danny, is between 276 and 822. Do you remember what? Hold on, I've got the numbers. We've got a bet with checkmate.
I went for 282.
Oh, so 1 standard deviation, you'd be on the money, Danny.
Yeah, I'll take that.
Let's have a look. Hold on.
In fact, fuck that. I hope you win.
Checkmate's on 250. Mine's 380. So we go above 1 standard deviation, even a little bit.
A little bit, but not crazy.
I hope you win that bet.
I'm there. I'm winning this bet.
Yeah, you're not crazy there. And I do think that based on how it's settled down, as we know, and again, it could overshoot it, but I'm pretty confident personally. Obviously, not financial advice, but I'm pretty confident on the on the 1 sigma moves. Let's say, and yeah, that's what it is. 270 at the end of 2025. It's about 275,000 is 1 sigma move up. The trend line itself, 127,000. So this is, again, in my opinion, look at the whole picture, look at all the data. I don't know. I just find it funny. Some of these other models, you can find this stuff going back to 2018. For me, it's nothing out of the ordinary, and the model adjusts. I'm happy to say that the model adjusts.
When do we hit 1 mil?
Well, you already hit it on 2 sigma up in August 2026, but the trend line itself. Actually, this is another point I wanted to talk about with the base money. You'll like this. So June 2033. So this is post 2 more halvings from now.
That'll be perfect for Real Bedford getting to the Premier League.
June 2033. So keep that in mind. Next one, really quick.
I'm going to be an old man though. Then I'm going to be 55.
Oh, dude.
54.
Just keep taking some of these. What are some of these live longer pills?
Virgin blood.
It's coming.
I'm going to start getting my children's blood.
Don't they do that in Silicon Valley? Some gross thing like that.
That weird dude does. What's his name?
Which one? There's a big pool.
No,
there's a big pool for you to say that.
Something.
Yeah, that weird fucker.
There's a big pool of people for you to call someone weird.
Like the chief freak of the freaks.
Brian Johnson, that's it.
Yeah.
Yeah. I'm sure there's many, many more. I think you're right. I think there's many, many more beyond him. But anyway, look, 1 on base money. Very easy for you guys. Remember this one. I'm not even going to break it down. This is the base money. You're only going to find it here on my website. Very exciting stuff. During the COVID, we hit a record of $30 trillion of money print. This is all the central bank money in the world put together. Okay. We've come down because we're rising interest rates, as we say. We're buying less government bonds, as we say. We're actually letting government bonds roll off the balance sheets of the central banks. We're destroying money, so it's coming down. Even if you measure, and by the way, this is also a Wittgenstein's rule, I think, because I'm putting this in dollars, but this is euros, yen, yuan, so you got to think about that. The dollar exchange rate comes into play here. Anyway, I'm going to do the Q2 update, which we finished Q2 3 days ago, as we know here, but it's going to takes time with central banks to get their data uploaded. Nonetheless, at the end of Q1, it was $28 trillion. Now it's going to be probably somewhere around $26 trillion of base money. But there's another way that we can look at this, and I've never shown this one before, so this will be fun. Is let's look at the Bitcoin market cap as a percentage of this number. Okay, because this is, I've said this 1,000 times, I won't repeat it on your show. This is the apples to apples analogous money supply for what Bitcoin is. Bitcoin is not a bank account. Bitcoin is not a money market fund. Bitcoin certainly isn't a stable coin, which is analogous to the money market fund. Bitcoin is not a treasury. Bitcoin is not real estate. Bitcoin is what the central banks print, it's base money, or you could combine it with gold and silver, which is not on this chart, but nonetheless, that's what we know Bitcoin is. It's outside money. It's outside the financial system. It's outside money. So let's just take the Bitcoin market cap and see how that compared. All right. This is now on the right hand axis. Bitcoin is a percentage of base money. Okay. So let's look at the percentage.
Yeah.
I'm rounding to zero all the way. Even when you get to the 2017 bull, we got to 1%. 1% of base money went back down to 0.3% in 2019. And then base money was printing, Bitcoin was pumping in 2021. So both were going up, as we see. Still, Bitcoin got to 3.8%, 4% in November, down again when FTX filed for bankruptcy with zero Bitcoin, 1.2%. And now, with the recent boom and price rise, we're at 5.2%. 5%.
So again, the trajectory's up.
Trajectory's up. It's up. So this is sort of the thing you got to keep in mind is base money can keep going up, can keep imprinting. Gold ounces can keep going up as they do. They keep getting mined. Bitcoin can also go up, but the percentage will be interesting. So let's run a regression now on this percentage. It's a different thing, but let's run a regression on this and see what it looks like. It's also a power curve. Very interesting. So let's see now, when will Bitcoin hit 100% of base money?
It's not long.
Not long, actually. And this shows you the power of the power curve. So it's 5% now, but again, right on trend, a little bit under trend. The actual percentage, Bitcoin versus base money in the world, 5%. The regression, 6%. Just for our listeners, I'm going to run my mouse out now. How long is it going to take to hit 100%?
Basically a decade.
There we go. October.
And so this is just the world remonetizing in Bitcoin.
Yeah, I think it's a good way to look at it. I think it's interesting. And I don't know exactly what that is going to be. So now let's project, let's remember, it takes until the end of this 2 more halvings, 2033, 100%. We think that Bitcoin could hit base money. So let's project the base money curve out now. All right. Let's project the base money curve out. Log scale. Now look, it's very simple. Most of finance, most of the economic world moves in exponential curves. Remember, we talked about linear, log, exponential, power, 4 basic curves. Most of finance works in exponential curves. Bitcoin does not. Bitcoin is a power curve. So they're going to intersect at different times. But as you can see here, look at this. This is the base money supply since 1970. It's $200 billion worth of base money in the 1970s. Now we're at 27 trillion. It's going to be lower this quarter. It's going to get down to 26 trillion, as I just said, because they're cutting the money supply, as we just talked about for a long time. But we can draw the same percentiles around this thing. We can project this thing out. We can even look at standard deviations, and let's go out to that same period, 2033, and let's see where this projects the base money supply to be at. In somewhere March, April, May, let's go to the end of 2023, $83 trillion. $83 trillion. I'm not saying that's for sure what it's going to be, but look at these 2 percentile bands. It's even a pretty good relationship here of how the base money supply grows versus the exponential growth, which is, as I've talked about, it's about 13% per year. 13% per year.
It's just math, bro.
And so, yeah, it's just math, bro. 83 trillion.
What does 83 trillion divided by 21 million give you? And is that the same as the projection for the Bitcoin price?
No, good question, Danny. And the answer is no. I got it here.
Fuck's sake, Danny.
You made it more complicated. I was going to leave it, but since Danny asked the hard question, I'm going to answer that question, but just really quickly again, here we got the Bitcoin supply on the right. All right, Bitcoin supply and Bitcoin's projected Bitcoin supply. And then on the left, we're going to show market cap. Okay, so this is Danny's question. But again, here's the regression. This is how it looks on linear scale. If I take the regression off, you can't quite understand how strong the Bitcoin growth is unless you put this, it's the same question like linear log, all this stuff. But if you actually put the power regression on it, see how strong that is. See how small the linear type. If we're looking at linear scale, left-hand axis, let's take the BC supply off. Linear scale, we put the curve on linear scale. Look at how strong that is. Imagine being Peter Schiff and betting against this trend.
But he is.
Do you understand how impressive this is? And it's a 96% R squared with the market cap. It's even better than the R squared with the price. That price is 95% R squared. So again, this is why
in 2033, Peter Schiff's going to be tweeting about Bitcoin dropping from 1 million a coin to 800K a coin in his fucking coffin.
All right, let's put it on log scale to give us a better view here. I need to take that off. Okay, log scale, market cap. Danny's question. It's different, Danny. The answer is it's different and it's lower. So this is just using the power curve of the market cap, not 21 million or 20.7 million coins, which is going to be. When we get to 2033 here, the trend line is 35 trillion. So something to keep in mind. You're running individual trend lines on different things, right? I did a power trend on the percent of Bitcoin versus the monetary base. I did an exponential trend on the monetary base. That took us to 80 trillion. And now I'm doing a power trend on the Bitcoin market cap itself. That's only 35 trillion. So there are gaps there. I'm not saying I can predict the future. I'm not saying I can predict the future, but we have 35 trillion.
Directionally.
Yeah, directionally for sure. We have 35 trillion if we go with the market cap. We have 80 trillion if we assume the power curve of the percent matches whatever the regular monetary base is going to be trending at, which shows us $80 trillion equivalent by 2033. And we have the potential of hyper Bitcoinization. The Michael Saylor, all your models are wrong. I'm fine with that too. But
any scenario, own Bitcoin.
Yeah. Imagine being Peter Schiff when you look at this chart on linear scale. That's my point. That's my point with this stuff. Look at how massive the 2 sigma up move is. And in here the 2 sigma up is 200 trillion, 240 trillion. By 2023, which might happen. We might hit we've hit 2 sigma before, right? We've hit it in 2017. We hit it in 2013. We hit it in 2011.
Oh, was that 20 million a coin?
I had the other. I had the supply on as well, just to show you where the projected supply would be. It's going to be about 20.7 million Bitcoin projected by 2033. So that's if you want to also compare that to the price projection and all the rest, but. A lot of different ways to project out. And I can't imagine how Peter Schiff, it's just hilarious how anyone could still follow him. He's been literally since 2011 been against this power curve.
Yeah. Well, fuck that guy.
Good stuff though, huh?
I can actually see 2. This will be funny for you. 1 second.
I think I know what's coming.
Keep him up on my shelf.
I've seen you.
The OG What Bitcoin Did pictures.
Yeah, I've seen you pod with him around the world. You've taken him around the world with you.
Taken around the world. Took him down the gym once, I think. I think he was going up and down on the weights.
It's a remarkable form of cognitive dissonance to be doing this for over 10 years now. It really is.
Honestly.
It's a science experiment.
I think it's that the saltiness index. He's like peak saltiness index.
Yeah.
I just don't. He would have been so fucking rich, and he didn't do it. And I think he's just angry now.
I would be more angry for the people that listen to him. His clients.
That's my point. It's the amount of money he's cost people by being a fucking moron for a decade.
100%.
Like, forgive him for a couple of years, but to be so consistently wrong, fuck that guy.
It's embarrassing.
This is cool stuff, man. Can we subscribe to these charts yet?
Yeah. You got some live charts on my website. Can you see my screen still?
Yeah, I got it.
So actually, I think the last pod I was on, you said I got to get it on the website. I got it on the website. It's here.
Are you charging for it yet?
It's here. No, not charging. This is for free.
But you should charge for this.
To all the listeners, my website has no cookies. I got no trackers. I just got a BTC link here. Donations well appreciated, and people have been donating. I really appreciate it. I'm going to continue it that way.
But you should charge for this.
Well, maybe. We got the YouTube channel. We're going to start doing more interactive stuff in the future, so that's also coming. Maybe there'll be some inside tracks for that. But I'm honestly, man, I'm enjoying the Bitcoin ethos of I got no trackers here. You can donate if you like it, and if not, go somewhere else. But we got the chart here. Here's just one last thing. Here's a table that shows you in number form what I talked about before. So the crazy 2010 trend, right, took us to 2.6 billion. If you held it till if the trend would hold till today, that's obviously we're not on trend. 2011, we're not on trend. 2012, but once you get to 2016, the numbers start looking very similar to the actual trend. So keep it. Pay attention to that. Would be my point.
Love the shit, man. Love it. Mežinskis, you're a superstar.
Always
appreciate you, man.
Always a pleasure. Always a pleasure. Never a chore. So Porkopolis.io is the economics website. Crypto Voices is the podcast, and my YouTube channel as well as Porkopolis. So it's all there.
Right. Well, we appreciate you, man. Thank you for doing this.
Thank you guys for going deep into the numbers. Always a pleasure.
Peace out, Danny. Thanks, listeners.
Thank you.
Get better, Danny. See you guys.